retirement. You've saved, you've built something substantial, but maybe the idea of constantly refreshing market apps, trying to figure out, the best time to sell your stocks, or just plain worrying if you'll outlive your money feels incredibly stressful. You're asking the big question, can I actually stop working and just, live off my investments without losing sleep?
It's a huge pivot point for so many people. That shift from building wealth to actually drawing income from it. Especially when markets feel, uncertain. It can definitely feel like stepping onto shaky ground.
Absolutely. And that's precisely what we're diving into today. We've been looking at some source material that lays out a very specific blueprint for retirement income, one focused on creating a low-stress dividend portfolio designed to potentially yield around 7%.
Yeah, think of it as a proposed path, a way to generate consistent cash flow from your portfolio, but specifically engineered to, hopefully, minimize the anxiety that often comes with retirement finances.
So our mission here is to really unpack this particular strategy. We want to understand the core idea, explore the specific components it suggests, see how the numbers might actually work in practice, and tackle those major retirement fears like inflation and market drops, all through the lens of this low-stress approach presented in the material. I'm frankly genuinely excited to explore how this aims for steady income and maybe even more importantly, peace of mind.
Exactly. We're going to try and extract the most useful nuggets from this blueprint so you can see if this specific approach, if it aligns with your own goals and your comfort level.
Okay, so let's start at the beginning then. Why dividends? Why this focus on getting paid for owning assets rather than chasing those, potentially huge growth stocks or trying to time the market? It feels less flashy, maybe.
It certainly doesn't offer the same thrill, right? No 10x moonshots or anything like that. But the core benefit this strategy leans on is receiving income passively, just for holding quality assets. You get cash flow without having to sell a single share.
So instead of needing to watch the market constantly, hoping for the right moment to sell when prices are high, the income just kind of arrives.
Precisely. And the material highlights several advantages to this. First, you bypass the need to time market sales. Second, you're not forced into selling assets at depressed prices during downturns, which is a huge stressor. Third, the right dividend-paying assets can offer a hedge against inflation. We can talk more about that later. And crucially, for the low-stress goal, it dramatically reduces the need for that constant portfolio checking, that constant worry.
Yeah, the source material uses a great analogy. It compares this kind of portfolio to a well-trained dog, quiet, loyal, reliably bringing you treats. It's about predictability over excitement.
Exactly. It's a fundamental shift in focus. From capital appreciation being the only way to fund your life, to the income generated by the assets themselves doing the heavy lifting.
But, okay, we know a high yield alone isn't the whole story. You can find incredibly high yields attached to some incredibly risky investments. The stress comes from the worry, right? So how does this particular blueprint define low stress? What characteristics does it prioritize beyond just that headline yield number?
Well, it outlines 5 key traits for what it calls a low-stress portfolio. First, and this is important, it emphasizes diversification across different sectors, not just concentrating in, say, REITs or BDCs, but spreading out across real estate, utilities, energy, financials, consumer staples, that kind of thing.
Okay, spreading the risk. Makes sense. What's next?
Second, the components should be reliable payers. The focus is really on companies and funds with long, proven track records of consistently paying dividends, and ideally growing them over time.
So staying away from those, let's call them toxic exes, who might suddenly cut the dividend when things get a bit tough.
That's a great way to put it. And that leads right into the third point, minimizing the risk of dividend cuts. A sudden cut can completely derail an income plan, and it's a huge source of stress. So this strategy tries to pick components where that risk seems lower.
Got it. Reliable, low-cut risk. And the final two.
Fourth, the portfolio should be reasonably liquid and, crucially, easy to monitor. If managing it feels like a second job or needs, a CFA designation, it kind of defeats the whole low-stress purpose. And finally, number 5, it aims for that target 7% yield, but only by combining components where that yield isn't inherently tied to excessive risk. It's described as finding that Goldilocks zone, not too hot, not too cold.
Right. Diversified, reliable history, low risk of cuts, easy to manage, and hitting that yield target responsibly.
Got it. So let's start specifics then. What are the actual ingredients in this particular low-stress income blueprint that the source lays out? Okay, so the material provides a pretty concrete allocation breakdown. It's a mix of things. Some individual stocks, some closed-end funds or CEFs, real estate investment trusts, REITs, master limited partnerships or MLPs, and also exchange-traded funds, ETFs. The goal is a blended yield of around 7.0% across all of them.
And we're going to look at each piece to see why it fits into this low-stress picture.
Exactly. There are 8 core components in this specific plan, and each one is included for a specific reason related to generating that reliable income or, reducing the stress factor.
All right, let's dive into the assets. First up is realty income, ticker O. The material calls this one the monthly money machine.
Yeah, realty income is, it's pretty well known in the dividend world. It owns commercial properties and leases them out, often under what are called triple net leases.
Okay, triple net lease. What does that mean in practice? For the landlord, for realty income.
Basically, it means the tenant, think Walgreens, Dollar General, places like that, is typically responsible for paying the property's taxes, the insurance, and the maintenance costs, not realty income. This structure, plus the fact that tenants are often pretty recession-resistant businesses, makes the income stream quite stable. The source highlights its 98% occupancy rate, and those monthly dividends is key to its low-stress profile.
And it yields around 5.6% currently, with a history of growing that payout. So it sounds like the stable, predictable, maybe even a little boring anchor for the portfolio. In a good way, of course.
That's exactly the role it serves in this blueprint. Stable and steady. Next up, we have Main Street Capital, ticker MAIN. It's referred to as the BDC you don't need to babysit.
Now, business development companies, BDCs, I feel like they're often associated with higher risk, aren't they? They lend to smaller, maybe less established businesses.
That's generally true, yeah. Many BDCs can be riskier or more volatile. But Main Street Capital is singled out in this blueprint, partly because it's internally managed.
Internally managed. How does that make it less stressful or potentially less risky compared to other BDCs?
Well, with internal management, the employees and the executives work directly for the BDC itself. They're not part of some external management firm that's just charging fees based on the assets under management. The structure often aligns management's interests more closely with the shareholders, which can potentially lead to more conservative, long-term focused decisions. The material points to Main's selective lending practices and its consistent monthly dividends. Plus, it sometimes pays out special dividends, too, which bumps up the effective yield.
Ah, okay. So you get that potentially higher yield around 7.2% plus those specials, but maybe with less heartburn than a typical BDC might give you. The source calls it the spicy part of income without needing antacids.
Oh, yeah, a fitting description for its role here. Then there's Enterprise Products Partners, EPD. The source calls this one the Energy Toll Booth. This is a master limited partnership, an MLP.
Energy. That word alone can feel volatile. Why include an MLP in a low-stress portfolio?
Well, EPD isn't really involved in the super volatile exploration and production side of energy. It owns and operates essential infrastructure. Think pipelines, storage tanks, processing facilities for natural gas and petrochemicals. It's more like they're collecting tolls for transporting and handling these crucial resources. The material really emphasizes its history over 25 years of growing payouts, which is impressive. Plus, conservative management and, yes, the tax advantage that MLPs offer.
Tax advantage. How does that work exactly with an MLP? Is it complicated?
So when you own an MLP, you receive distributions. And often a good portion of those distributions are considered a return of capital, which means they're tax deferred until you sell your units. However, it is worth noting, MLPs issue a K-1 tax form, not a standard 1099 DIV. The K-1 can add a layer of complexity to your tax filing. But the blueprint includes EPD for its stable fee-based business model, and that yield, currently around 7.3%.
And I remember the source mentioning something about EPD actually liking inflation. How does that work?
Right, because a lot of its contracts for using its pipelines and facilities have rates or tariffs that can be adjusted based on inflation metrics. So it can often pass through rising costs and maintain its profitability even when prices are going up elsewhere. It has pricing power.
Interesting. Okay, moving on to something different. JP Morgan Equity Premium Income ETF, ticker JEPI, the Covered Call King. Now, this involves options, which can sound complex and maybe a bit risky to some folks.
It can sound that way, sure. JPI is an actively managed ETF, and its main strategy to generate income is by selling covered calls on a portfolio of large-cap U.S. stocks it holds.
Covered calls. Can you break that down simply? What are they actually doing?
Yeah, in simple terms. The fund owns the underlying stocks, think big names like Apple, Microsoft, Amazon. Then, it sells someone else the right to buy those stocks from the fund at a certain price, the strike price, by a certain date. For selling that right, that option, the fund receives cash, which is called premium income. Now, this strategy limits some of the upside potential if the stock price really takes off, goes way above the strike price. But in return, it generates significant current income from those premiums, which is exactly the focus for a retiree needing cash flow.
Ah, okay. So it's basically trading some potential big gains for more steady, predictable cash flow right now.
Exactly. And the material points to JP Morgan's management, the fund's relatively low volatility compared to the broader market, especially for an income fund, and its monthly income distribution as reasons why it fits this low-stress framework. It's yielding around 7.5% right now.
Makes sense. Okay, next, maybe for those thinking about the tax man, Nuveen AMT-free municipal credit income, ticker NVG. The source calls it tax-free and chill.
Right. This one's a closed-end fund, a CEF, and it invests primarily in municipal bonds, or munis. The key benefit here, as the name implies, is that the income generated from these muni bonds is generally free from federal income tax. And depending on where you live and which specific bonds the fund holds, it might also be free from state and local taxes.
Ah, tax-free income. That definitely makes that yield, what is it, about 6.8%, look a lot more attractive, doesn't it? Especially if you're in a higher tax bracket. That's the whole tax equivalent yield thing.
Precisely. The tax equivalent yield tells you what a taxable investment, like a corporate bond, would need to yield to give you the same amount of money after taxes as a tax-free muni bond. For folks in higher brackets, it can be a significant boost. The source includes NZG for this tax advantage, plus its professional management. It notes it's a pretty widely held and established CEF in the muni space.
Okay. And speaking of CEFs, the next one is the Reeves Utility Income Fund, UTG. Defensive with a power plug. Utilities.
Yeah, they definitely feel inherently low stress. They often are considered defensive, yes. This fund, UTG, invests in utility companies, but also things like telecom and other infrastructure assets. The basic idea is people tend to pay their electricity, water, and phone bills even when the economy is struggling, right? They're necessities. The material notes UTG's long history of paying monthly dividends, its solid performance in terms of net asset value, or NAV.
NAV. Can you just remind us what that is in the context of a fund like this?
Sure. NAV, net asset value, is essentially the per-share value of all the fund's underlying assets, its stocks, bonds, whatever it holds, minus any liabilities it has. Now, for a closed-end fund like UTG, the market price can sometimes trade higher or lower than the NAV based on investor demand. But seeing strong NAV performance over time generally indicates that the actual investments the fund holds are doing well and holding their value. The source also mentions that UTG uses leverage. It borrows money to invest more.
Leverage. That usually adds risk, though, doesn't it?
It can, absolutely. Leverage magnifies both gains and losses. So if the investments do poorly, the losses are bigger. But the material suggests that UTG's management uses this leverage relatively conservatively, and that the yield, which is pretty high at around 8.1%, combined with the defensive nature of the utility assets, makes it a strong income contributor within this specific blueprint. It's seen as kind of an income hedge because those utility payments are generally non-discretionary spending for customers.
Gotcha. Okay, seventh on the list is one many people might know. The Vanguard High Dividend Yield ETF, ticker VYM, the source calls it the Dividend Steady Eddy. Vanguard's always associated with low costs and broad exposure.
Exactly. VYM is your classic broad market ETF, but focused on U.S. companies that have a history of paying dividends, particularly higher than average dividends. It holds hundreds of stocks, including lots of well-established names you'd recognize, Johnson & Johnson, PepsiCo, ExxonMobil, companies like that. Its ultra-low fees and wide diversification make it a really simple, low-drama way to get exposure to solid, often quite recession-resistant dividend-paying businesses.
Right. Its yield is lower than some of the others we've discussed, maybe around 3.5%, but it provides that wide base and stability from those solid, often dividend aristocrat type companies.
Yes, exactly. Dividend aristocrats, for listeners who might not know, are typically defined as companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. VYM gives you broad access to that type of quality, reliable payer, which definitely contributes to the whole low-stress goal.
And finally, the eighth piece isn't actually an investment security itself. It's cash or short-term CDs. The blueprint allocates a pretty significant chunk here, 15%, calling it your dry powder cushion.
Yeah, this 15% isn't meant to be invested in the market. It's intended to be held in highly liquid, very low-risk assets. Think high-yield savings accounts, maybe one-year certificates of deposit, or short-term U.S. Treasury bills, things that are safe and easily accessible.
And the purpose is primarily to avoid having to sell your other stuff during a market downturn if you need cash.
Precisely. That's the core reason. If you need cash for living expenses, and the market happens to be down significantly, this cushion provides that cash. It prevents you from being forced to sell your income-producing assets, your main, your APD, at really unfavorable prices just to pay the bills. It adds a significant layer of psychological comfort, that peace of mind.
And right now, with interest rates where they are, that cash component isn't just dead money, is it? It can yield maybe around 5%, contributing meaningfully to the overall blended yield while still providing that crucial safety net. Cash flow plus peace of mind.
That's absolutely the idea behind its inclusion.
Okay, wow. We've got the components, we've got the logic behind why each one is supposedly in there for low stress and income. Now for the big question. Based on this blueprint, and using the example size provided in the source material, which was a hypothetical $500,000 portfolio, what kind of actual income are we talking about? What could this potentially generate?
Right, so based on the specific allocations and the yields listed in the material at the time it was written, the source calculates the potential annual income from each part of that $500 K portfolio.
Okay, let's walk through that quickly. Realty income OWAL, they allocated $75,000 at a 5.6% yield, so that's $4,200 annually. Main Street Capital Maine, $50,000 at 7.2%, adds another $3,600. Enterprise Products Partners, EPD, $50,000 at 7.3%, contributes $3,650.
Then you have JPI, the covered call ETF, $75,000 allocated at 7.5%. That's a big contributor at $5,625. NVG, the Muni Bond Fund, $50,000 at 6.8% tax-free, adds $30,400. VYM, the Broad Dividend ETF, $75,000 at 3.5%, adds $2,625 for.
And finally, that 15% in cash or CD, $75,000, assuming a 5.0% yield, brings in another $3,750.
The total annual income from this specific $500 allocation based on those numbers comes out to approximately $30,900.
Okay, $30,900 a year, which, quick math, that's about $2,575 per month. The calculated blended yield on the $500 is around 6.18%. But the material makes a point of saying the effective post-tax yield is actually higher, right? Because of the tax benefits from NVG and maybe parts of EPD's distributions.
Exactly. The tax treatment boosts the actual take-home amount compared to a portfolio yielding the same amount entirely from taxable sources. And the key takeaway presented here isn't that this is some kind of get-rich-quick scheme. It's not. But it is designed to generate, in this example, over $2,500 a month in passive income from a $500,000 portfolio, with a specific focus on minimizing stress and volatility along the way. The goal is to cover monthly living expenses without needing to sell off chunks of your portfolio.
That really does shift the focus entirely, doesn't it? From constantly worrying about the day-to-day portfolio value fluctuations to simply focusing on receiving that monthly or quarterly income stream. But what about those big retirement anxieties? Inflation is always a persistent worry. How does a strategy like this address the rising cost of living over time?
That's a critical question. And the material asserts this blueprint does include inflation protection mechanisms, kind of built into its components. For instance, realty income often has rental escalators built into its leases, meaning rents can increase over time, sometimes tied to inflation. EPD, as we discussed, operates in an environment where it can often pass costs through via tariff adjustments. GPI's underlying option strategy naturally adjusts with market volatility, and volatility can sometimes increase during inflationary periods, potentially boosting the premium income it generates.
Okay, so those have some built-in adjustments. What about the others? Do they contribute to the inflation fight?
Well, Maine and UTG hold investments in businesses, or are businesses themselves, that have the potential to increase their earnings and, consequently, their dividends over time. That dividend growth is key to helping your income keep pace or even outpace inflation. VYM, with its heavy exposure to those dividend aristocrat-type companies, inherently holds businesses with long track records of raising their dividends year after year, often faster than the rate of inflation. And even the cash component isn't totally defenseless. As interest rates tend to rise during inflationary periods to combat inflation, you can roll over those maturing CDs or T-bills into new ones offering higher yields.
So the idea is you're not just sitting there watching your purchasing power erode. There are mechanisms within the portfolio designed to fight back against rising prices. Okay, that's somewhat reassuring. Now, what about the other big fear? Market crashes. We've all seen them. How does a portfolio constructed like this supposedly hold up when, everything seems to be plunging?
The fundamental premise here is that this portfolio is built to be held through those downturns, because the income stream is the primary objective, not the day-to-day market value. And the income stream from these types of dividend-focused assets is generally stickier, less volatile than pure capital gains, which can disappear quickly in a crash. The source looks at some historical examples, like it mentions Owen Main saw their share prices dip significantly during the initial COVID panic in 2020, but their underlying businesses proved resilient, their dividends held up relatively well, and the share prices rebounded.
Right. And EPD, you mentioned, didn't cut its actual distribution payments during that period, even if it maybe slowed down some capital spending?
Exactly. Maintaining the payout was the priority. And while JPI is neuter, launching after the initial COVID crash, its option strategy is designed, in theory, to provide some buffer in volatile markets compared to just holding the underlying stocks. Now, yes, the CEFs like UTG and NVG use leverage, and leverage can exacerbate drawdowns in a crash. That's a risk to be aware of. But the material notes their management aims to use that leverage conservatively and within certain limits.
And the ultimate buffer, the real safety net in a crash scenario, is that 15% cash cushion we talked about.
That's positioned as the emergency brake. It's there specifically so you have immediate funds for your living expenses without being forced to sell your income-producing assets at the absolute worst possible time, locking in losses during a panic.
Okay, so let's say you've set this up, you're in retirement, and the income is flowing in. The blueprint presents two core options for what you actually do with that income, right? Withdraw or reinvest.
That's right. Option A is really the primary goal for someone who is in retirement. Simply withdraw the income. Use that, in our example, $2,575 a month to cover your bills, fund your travel, pursue your hobbies, whatever your retirement looks like. That's the point of this specific approach to financial freedom, actually living off the income your assets generate without depleting the principal, hopefully.
And option B is more for someone who maybe isn't fully retired yet, or perhaps they just don't need all the income generated right away.
Correct. If you don't need the cash flow immediately, you can choose to reinvest the dividends back into the portfolio. And the material provides a pretty powerful illustration of this. It suggests that reinvesting that roughly $30,000 annual income from the $500K example, even without adding any new capital from savings, could potentially compound into an additional $415,000 or so over a 10-year period. And that's just from the power of those reinvested dividends buying more shares, which then generate more dividends, which are then reinvested again. It really shows the potential for growth, even within an income-focused portfolio, if you let it compound.
That's pretty compelling. Okay, so this deep dive into the specific blueprint has given us a really clear view of one particular strategy for aiming for a low-stress, income-focused retirement. The core message, as presented in the material we looked at, seems to be about generating regular, reliable income with hopefully minimal day-to-day monitoring, building in some protection against inflation, maintaining diversification, and ultimately trying to foster that crucial peace of mind.
Yeah, it really reinforces the idea that retirement doesn't have to involve the constant hustle and stress of trying to play the market. It can be more about setting up a system, a machine, if you will, that reliably pays you for owning it.
And that leads us right to the final thought that was presented in the material, something for you, the listener, to really maybe sit with and mull over. No more worrying about outliving your money. Instead, you'll wake up every month knowing your portfolio just paid you to be alive. And that, my friend, is what financial freedom actually looks like.
It's a powerful reframing, isn't it? Shifting the mindset away from the anxiety of watching your capital potentially run out towards the security of a recurring income stream that's derived from your investments, supporting your life.
So think about how this specific approach aligns with your personal vision for retirement, your comfort level with these specific kinds of assets, the CEFs, the MLPs, the REITs, and your own tolerance for different kinds of investment risk. This deep dive has explored one potential blueprint for living passively off your investments. Now, it's really up to you to consider if this path resonates and maybe warrants some further exploration based on your own unique circumstances and goals.